Let's take a few moments and look at a sale-leaseback transaction. First, what is a sale-leaseback transaction? Well, really that's where the owner of an asset sells it to another party and then immediately leases it back from the new owner. Sounds strange, it could be, but it does happen quite a bit. For example, sometimes when you have a housing development and you purchase the model home, you buy the model home there, and then they will lease it back from you for 2 or 3 years so that they can use it as a model home, and then at the end it reverts back to you. So it's a neat way for you to buy a house in a location you maybe want to be in a couple of years without any real cost to you. So it's sort of a neat transaction. So it does happen. But in a sale-leaseback transaction, 2 things happen in that transaction. One, the seller-leasee receives cash from the sale of the asset. Then the seller-leasee pays periodic rent payments to the buyer or the leaseor, the new buyer, to retain the use of the asset for some period of time. Now, when we have this type of arrangement, there's 2 different ways in which we account for it. One is the sales-leaseback approach, and 2 is the financing arrangement approach. So one, in the sales-leaseback approach, we record the sale of an asset, and then we record a lease to the leaseback portion. Now in this, it can only happen this way if the lease, when we lease it back, qualifies as an operating lease. If the lease, when we lease the asset back that we just sold, qualifies as a financing lease, then we have to do the financing arrangement. In this case, what happens is we view it not as a sale, but it's basically a loan by the lessor to the lessee for the sales price of the asset. The asset remains on the leasee's books, and the leaseback is accounted for as a debt item. The lease payments are deemed to be repayment of the so-called loan. Why is that? Well, if you really think about it, if you retain ownership after, as what a financing lease looks like, it looks like you've bought an asset, then you really have no sale at all. So you can't record it as a sale. We do not record it as a financing lease. We simply record it as we borrowed funds. So let's look at these 2 different ways to account for these assets. So let's start with this first example here. To raise operating funds, Signal Aviation sold an airplane on January 1st of 2024 to a finance company for $830,000. So we needed an inflow of cash. One way we could do that is sell the plane and then turn around and lease it back. Signal immediately leased the plane back for a 12-year period, at which time the ownership of the plane will transfer to Signal. So remember, Signal here is the seller and the leasee. So we've got a transfer of ownership to the leasee at the end of the term. So this would indeed qualify as a finance lease. And once it qualifies as a finance lease, we have to treat this under the financing arrangement, not as if it's a lease. Okay? So the airplane has a fair value of $860,000. Its cost and its book value were $630,000. Its useful life is estimated to be 14 years. The lease requires Signal to make payments of $110,740 to the finance company each January 1st. Signal depreciates assets on a straight line basis. The lease has an implicit rate of 10%. Prepare the appropriate entries for Signal on January 1st and December 31st to record the transaction and necessary adjusting entries. So again, when we look at this, the transfer of ownership indicates that the leaseback arrangement would qualify as a finance lease, not an operating lease. So therefore, we cannot use the sale-leaseback approach here. So the transaction does not qualify for that approach. So when we look at the transaction, we have to look at it not as a sale, but as if we're taking a loan from the finance company for $830,000 or the sales price. The asset actually remains on the leasee's books because it does transfer back to us. Almost think of it as collateral, or you sort of use the plane as collateral for a loan instead of a leaseback. All right, so what do we need to do in that instance? Well, one, if you were to bring the value back, the $110,740, if you found the PV of that, you would end up at $830. So really quickly, why don't we do that just to verify that we can get $840, and we'll just do it here in our debit. So if we go in and says okay, equals our negative present value. So we got our rate. We know our rate is 10%. And then in this, the period is 12. So it's a 12-year lease. And it is an annual payment, I do believe. Each January 1st. So yes, so it's an annual payment. So there we go. And then our payment is $110,740. There is no future value because this is an annuity. And then our type, it is due at the beginning of the period, I do believe, if I read that correctly. So when we do that, notice we get $803 and $3. Well, why? Because this 110 is actually rounded, that would have some pennies in it. So we see that the present value of the minimum lease payments would be the $830, which just so happens to equal the amount that they're lending us. So the way we treat this is we receive cash of $830, just like we would if it were a sale. But instead of recording a lease payable or any type of lease transaction, we actually record it as a notes payable. We treat it as if we simply borrowed $830,000 from the finance company. And that's it, because the ownership of this plane will come straight back to us at the end of the period. Think of it as collateral. We leave it on our books. They simply give us money for it. If we miss a payment, they own the plane, so then they can use it to recoup any funds lost. All right. How does that impact? Well, our assets go up $830, and then so do our liabilities. Now, what type of activity? Well, this would be an inflow of cash, $830, from financing activities. It is not a sale, so therefore we are borrowing money. So be careful with that. If you were to sell it, it could be from investing because you're selling a long-term asset, but here we are actually financing that asset. Okay? So then what else happens? Well, remember on day one, we do this first payment. So we're going to make a payable of $110,740. Keep in mind there would be no interest because no time has yet passed. So all $110,740 is considered a pay down of the principal. So our cash is going down. Our debt is going down. No impact to the income statement because there's no interest yet. And then we've got an outflow of cash from financing activities. All right, now what happens on December 31st? Well, at the end of the year, remember we will not make our next payment till January 1st. But as of December, we would accrue interest. So all we need to do is our interest expense and interest payable, just like we do on any note payable that we would have that crosses a year in. So one, we have to figure up our interest. So our interest would equal our principal balance minus the payment. Why is that? Because currently our debt is sitting on our books at $719,260. That's what we would actually accrue interest on. We're going to multiply that by the 10%. Not by 10. 0.10. There we go. We get $71,926. So that's the amount of interest that we would accrue this period. We will actually make that payment on January 1st. So on January 1st, when we make the next payment, we'll simply do interest payable of $71,926. The note payable of the difference, and then cash of $110. So instead of hitting interest expense on January 1st, we would just clear out that interest payable because that does represent 1 full year of interest. All right. Now in this case, our liabilities are going up because we're not paying it yet, and our equity goes down. So we're reducing the overall equity of the company. So expenses are going up. When expenses go up, our income for the company goes down. There is no cash flow here because we're not yet making the payment. That would happen on January 1st. All right. Now the next thing that we have to do, remember we retain ownership of this asset. So we need to go in and actually record depreciation for that period of time. So that would be a debit to depreciation expense to record the depreciation, and we would credit our accumulated depreciation account. Okay, let's indent that just a little bit and fix our formatting. There we go. Now how much? Well, the asset is sitting on our books. It costs a book value of $630. It is a useful life, is estimated to be 14 years. So it's a 14-year life. So we'd take that $630, the amount it originally cost us, because remember we already own this asset. So that $630 is what its book value is sitting at this point, and divide that across the 14 years. just like we would. So we would just continue to depreciate this asset as if we owned it and nothing had changed. Okay. And when we record depreciation, our assets go down, and so does our equity. That's because we have recorded an expense, so our income goes down, and then there is no cash flow there. All right, so keep that in mind. If you have a sale-leaseback, and the actual lease itself would qualify as a financing lease on the leaseback, we have to treat it as a financing agreement. In other words, all we're doing is borrowing funds. We retain ownership of the asset because here especially it's transferring to us. If there's any other reason, then we would also retain ownership, and then we would simply depreciate the asset as normal. Okay? Now, in the next video, what we're going to look at is, well, what if it would qualify for the sales-leaseback approach, which means we have a lease and it would be an operating lease after that point. So that's our next video.